Welcome, everyone. I'm Susan Murray. I'm one of the partners at Trust Associates, and on behalf of my colleagues and the team at Edison, I'm delighted to welcome you to the third in a series of webinars on topical issues affecting investment companies. Delighted to have three speakers joining us today. We have, in order of speaking, we have Piers Currie. Piers is a partner at Warhorse, and he's very well known in the marketplace. Started his career as a freelance writer and market communications consultant to the city firms, and he's held various marketing and communications roles at Aberdeen before setting up Warhorse Partners a couple of years ago. Our second day is going to be Simon Westlake. Simon, again, I'm sure is well known to many of you. Simon is head of corporate governance at the City of London Investment Group, and he started his career in investment management as well, with roles at Gartmore and at Charles Taylor, before joining City of London in 2008. And last but certainly not least, we will have our third speaker, Ewan Lovett-Turner. Ewan is a director of investment company research at Numis Securities. Ewan's got over 15 years experience in the sector, and he heads up the very well-regarded investment companies research team at Numis. So just a couple of housekeeping points before we go on and listen to our three speakers. Each speaker is going to speak for around 5 to 10 minutes maximum, leaving plenty of time for questions at the end. And we're going to aim for a finish time of around 11:45. If you would like to ask questions, and please do, if you could use the questions tab at the bottom of your screen, and we will do our very best to cover just as many of them as we possibly can. Now, many of you will have joined us for our previous two webinars, which focused on, firstly, the broader challenges affecting investment companies as a result of COVID-19, and secondly, a focused one on the dividend challenge. Well, we've listened to your feedback about the topics that particularly interest you, and one particular theme definitely stood out: consolidation and change in the industry. So without further ado, I'm going to head across to our very first speaker, Piers Currie. Piers.
Thank you. I hope I'm audio. And well done for getting us all together and turning up on time. And thank you very much to everybody to coming in to listen to us today. I've enjoyed the previous webinars that you've done, Susan, so well done for getting us to corral to be able to explain what it is that we're going on. And I'm at the front of the show in terms of my end of the bookend is going to really look at the changing landscape of the overall investment trust sector, which is something that I do with Richard Davis's data and with Richard once a year. And last year we were in person, actually. We did this presentation in an office in London. And of course, today we are grappling with our technologies to be able to share in quite interesting and new and dynamic ways. So with only a short time to run through things, what the point of shareholder segments changing gear is really trying to look at the overall sectoral changes, which for some boards is quite difficult to observe. In board papers, typically one will see one's own company's register. The point of having a sectoral analysis is to really identify the difference between what is specific perhaps to one company and individual concerns, but what is also happening across the sector. And there are items which are happening across the board, which I think is worthwhile sharing because it allows directors to map where they fit in with the changing dynamics, both of liquidity of their company and also the appetite or interest in the company and what's going on. So my kickoff slide from Richard's data, this is very useful data because a lot of surveys examining who owns investment trusts can be used from sampling. Richard actually covers a vast proportion of the share registers in very granular detail. So about 75% of the sector, which accounts rather conveniently for 110 billion, although this actually only means 220, but is a large enough sample for us to take the data seriously. The problem with a sector analysis is typically it's big numbers. 110 billion and the percentages therein are eye-watering if one granular way tries to analyze everything that's going on. But you see in front of you now the three main bits of the pie of investment trust ownership are institutions, what we now call national wealth managers, or stockbrokers of old that have national coverage. And the third, which is one which is capturing more and more attention for boards now, is the very large slice of 35% of the sector is now owned, which is known as D2C platforms, direct to consumer. And they are the largest single chunk in terms of buying appetite for the overall industry. Two less significant operators, though they capture a lot of conversation and a lot of missionary work nobly done by the AIC, are the elusive but non-engaging IFA market, mainly because they are para planners or they're buying through discretionary fund managers, managed portfolios, and they're not really brokers in the old-fashioned sense. It's more to do with tax planning, and have still not managed to be able to use investment trusts in portfolios because they're not in portfolio management, and most of them are in tax planning. The regional wealth managers are a smaller slice than the nationals. They are also a hope for the industry because that is the group that often typically run portfolios without whitelists or the constraints of centralized buying, which is a massive influence now on national wealth managers. You'll all be aware of the professionalization of wealth managers who are increasingly raising the bar for minimum market cap figures and also restricted lists as to what is available to the brokers to be able to buy. And if one doesn't hit their targets, you will find that there is no increased buying, no matter the merits of the companies if they are too small. We'll probably hear a lot later or a bit later in this conversation today as to the problems of being too small and also too liquid. So the pie is an interesting shape. It looks like there's institutional 29% of the sector, but actually it's a very concentrated group. There's a long tail of not very large buyers or holders in investment trusts, but the top 10 institutions account for 2/3 of all the institutional buyers. Of the top 10 institutions, 2/3 of the buyers are institutional. It's even more concentrated that the top 10 national wealth managers account for 75% of that particular segment of the pie. And the D2C platforms, 5 platforms alone, account for 75% of that particular constituency. So it's quite a small group. And what we're seeing is each of these different segments have different expectations and needs, which the boards need to try to address. The main trend, if people are able to manage it properly, is to get the elusive retail or D2C audiences to take an interest in the companies. And that requires quite a lot of precision work to not just let the market passively see shares being bought. This group, particularly D2C, require consistent engagement. And that's a difficult basis because their buying sizes and their scale operates in a completely different way to the very large institutions. And to try to give a sense of context, City of London, speaking in a minute or two, has about 2 billion and is the 3rd largest institution in the institutional sector. They're part of a group of some 40% of that group are what are known as activists, activist investors. So they're very engaged. And the City of London, and you'll be familiar with Lazard and also 1607. And these are engaged institutions, and they are often appearing to trade off one another's positions, and they have an enormous influence in terms of expectations, which we'll hear probably from Simon in a minute. Another vast chunk of that institutional group are the index funds, and the index funds are really inert to the merits from an active management point of view. They are buying if the markets are going up, and they're likely to sell if they're going down. The wealth managers have a different constituent problems, both with the barriers or imposition that is being prescribed as to what vehicles are available to them. So the only easy, if it's easily managed group, which is a more demand-driven for the sector at the moment, is coming from the D2C platforms, most famous of which probably is Hargreaves Lansdown. But even these platforms are being disrupted in a way which is exceptional. We've seen Interactive Investor acquire Alliance Trust Savings, and now they've bought the Share Centre. And those two big platform owners are, of course, they are transaction centres. And it's not really the question of with us, how do we get to reach the platforms better? It's how one reaches Mr. and Mrs. Miggins, who are using these platforms as means to be able to buy the stock. So they're not oversighted often by quasi-portfolio managers helping decisions. The end investor, the D2C investor, is making their own choice. So this is the slice of it. And if you looked at your own share registers, this would probably be quite a good way to benchmark as to what the balance of your own ownership base is, but they're changing. And the key thing behind two business metrics, which I think boards need to be attentive to. The one is the growth rate of retail penetration for your particular company. Some years back, I had a chairman from another trust explain to me how excited they were to double their retail penetration of issued share capital. And it turned out after the end of the conversation that they didn't double retail, they'd halved their institutions. And the institutional migration away from investment trusts has been steadily happening for 15 to 20 years. And if you look at the registers for institutions, many are no longer there. County council, pension funds, life insurance, buyers of old simply do not operate in investment trust space. So with that shrinking pool and a very dominated version now for the institutional base, the D2C buying base remains the most influential source of cash flow. So in this chart, we're trying to take out performance data to try to produce a sterling outcome which takes out performance and say, what is the cash flow coming into the companies? And you can see that the D2C component, if attended to, is a vast proportion of the overall demand for the company's shares. In inverse, lack of attention to that particular audience groups will mean that there is a hole or an operating transition that will happen between institutions and the national wealth managers. The dominant wealth managers have been migrating. If we look at the pattern for companies such as Investec Wealth, Rathbones, Brewin Dolphin, and Quilter Cheviot, which are large investment stockbroking firms, they are net negative in terms of their migration away. So to stop the bath, if one pulls the plug out, leaking out altogether, it's quite important to turn the taps on if things are going to remain stable. And that primarily means trying to appeal to the D2C audiences. D2C doesn't operate in quite the same way of professionals. And I put in a chart here, which is the top 20 investment trusts that have been bought through the Interactive Investor platform. That's either the second largest platform group, but these are individual trades. And Interactive Investor, as you can see, has a very large chunk of, and because it's bought Alliance Trust Savings, of transactions for the first 5 months of this year through well-known and well understood investment trust companies, largely because they're visible and they have been doing it for a long period of time. I put in, just for the sake of amusement, just to turn away the point that it's all about performance in inverted commas. Not for this audience it is. What it is really they want the trust that they buy to be very consistent, very articulate, and to be doing it for a long period of time. And the actual
Piers, I would love to hear more, and I know we're going to have time for questions at the end, but I'm going to be in trouble with our other speakers and indeed with our man behind the scenes on timekeeping. So can I ask you just to focus a little bit more and get to the end of your bit, please? Thank you.
Yeah, sure. apologies, easy to rabid on.
That's
And
okay, no problem.
aware of the time. You did ask about COVID-19, and there wasn't a huge amount that I felt in the overall pattern of what I'm expecting, but we're all coming into online tools now, and I think it's very good that you're leading us in the right direction, Susan. And whilst the private investor is alarmed by the COVID situation, there hasn't been a massive defection away from the markets, according to the surveys that are being conducted during this difficult period for all of us. So I will get out of your hair and to be able to return you back to your grid.
And I promise you loads of questions at the end, Piers. I'm sure the audience will help us out with that. Thank you. I'd like to pass over without any further ado to Simon, please.
Thank you very much, Susan. I'm Simon Westlake. I'm the head of corporate governance at City of London Investment Management. And good morning. Susan called me on Friday with the housekeeping rules, and these included strict instructions to be pleasant and polite. I'm sure that won't be a problem, but if I do get cut off, hopefully the blame will lie squarely with British Telecom and not Susan deciding that I've overstepped the mark. One advantage of our enforced isolation is that it has provided an opportunity for reflection, and so this morning I want to reflect on City of London's idea of what a model investment trust looks like. I'm going to suggest 5 key issues for you to consider to ensure that your company is a model investment trust. Performance tops the list. It's our #1 priority. City of London's objective is to deliver superior investment performance for our institutional clients when compared to a relevant benchmark. We achieve this principally by exploiting discount volatility, and that sometimes leads to accusations of short-termism. But I would note that we have been continuing shareholders in our largest investment trust holdings for over 20 years in some instances. We are long-term shareholders. Of course, even the best managers go through periods of poor performance, which can last for several years. Nevertheless, closed end does not mean never end. There is a point when a board should say enough. I know for many of you this is not controversial. Recent examples of board initiatives do indicate an appetite to take action. Witan Pacific's decision to reinvent itself as a China fund is a great example of a board offering the market a product that investors actually want. And the merger between Perpetual Growth and Income, proposed merger between Perpetual Growth and Income and Murray Income, is also a welcome transaction that kills the bad, rewards the good, and lowers ongoing costs for investors. The second point, the cornerstone of our policy on investment trust governance is that boards should be fully independent of the manager. British Airways wouldn't nominate an NED from Boeing's marketing department. Why should investment companies be any different? Consider the following list of important board functions that I've taken from the AIC website. Monitoring performance, replacing the manager if necessary, negotiating fees, monitoring risk, ensuring assets are appropriately safeguarded, discount management, and deciding if new shares should be issued. The point here is that all these important tasks that you undertake are best tackled by directors who have no conflict of interest with the manager. And finally, on this issue, a word on the 9-year rule. We support it, though we do agree that some flexibility may be desirable on a case-by-case basis where a refreshment policy is underway in the interests of continuity. The third point I've put down is competitive costs. Well, actually, I've put low costs, but I think probably competitive costs is a better way of describing this. And this is no longer controversial. The relentless fee pressure in our industry is now firmly entrenched in the investment trust sector. We do believe that management fees for trusts are probably still too high. Not probably, they are still too high, but we know you're all on the case. And the point I want to make now is that when you are researching the right target for a competitive IM fee, the right comparative is not other trusts or even open-end funds. In our view, it's the institutional fee rate for your strategy. My fourth point covers responsible investment, stewardship or ESG. Call it what you will. The fact is that our clients think ESG is important. Over 90% of the RFPs that we receive ask about our ESG approach, and our clients are requesting additional meetings with us specifically to discuss ESG. Yes, performance is the key factor, but our US healthcare and education endowment and foundation clients increasingly ask for assistance so that they can provide more information to their stakeholders, their donors, and their beneficiaries, students, for example, about the ESG characteristics of their portfolios. Most investment trusts fall short on this point. Let me give you an example. The new Stewardship Code, UK Stewardship Code, requires signatories to explain how they have considered climate change risk in their strategies. Some of you do report your carbon footprint compared to your benchmark, but most annual reports give scant information on this point. Many completely omit any comment on this issue at all, but I'm sure this will change. In fact, it must change if your investment manager intends to sign up to the new code. The point I want to leave you with on ESG is, please help us to help our clients. We're not trying to tell the manager what to buy and sell, but we are asking for increased transparency. The final point on this slide concerns investment performance. And if you'll forgive me for stating the obvious, our clients don't see your NAV return. They see the share price return. And that is why discount control is so important to us. City of London believes that all investment trusts should have a discount control mechanism, a clear policy backed by action if necessary, which means an active share buyback. Shareholders also like redemption options. Of course, this is a potential threat, but it is also the acid test that proves that you are giving your shareholders what they want. We invested in the Wise Career Opportunity Fund at its launch 7 years ago and have since increased our position, having largely declined the 2 redemption opportunities that have since passed. So these, therefore, are our 5 KPIs for a model investment trust. Outperform your benchmark, a board of fully independent non-executive directors, competitive costs, more transparency with respect to ESG, and effective discount control. But the most important of these is performance, and this brings me to the final message that I want to leave you with today. If I can have the next slide, please. Performance conditional tender offers are a fairer deal for your shareholders. Our clients all have long-term investment horizons, but they nevertheless demand outperformance over an investment cycle. There is no point in active management unless the strategy ultimately outperforms its benchmark. In our view, a redemption option imposes normal market discipline by removing assets from an underperforming manager, and by pricing the tender at close to NAV, they provide a valuation uplift to the shareholder. We believe this is a great alignment of interests. Yes, we strongly support closed-end funds, but a sustainable structure must acknowledge the requirement to meet performance targets over a period that is fair and reasonable, both to long-term investors and to the investment manager. You may be thinking, well, that's what our continuation vote is for. But this nuclear option does not meet the needs of all shareholders. Continuation votes are important, but there is an interim step that can fill the gap between the binary decision to continue or not to continue. And I would like to suggest that conditional tenders are that step. They give a fairer deal to your long-term shareholders, and the manager gets a further chance to demonstrate his investment prowess with at least 70% of the ongoing assets. So that completes the points that I wanted to make this morning. The 3 points that I would prioritize are: first, set your sights on an institutional management fee. Secondly, encourage your manager to be more transparent about the ESG characteristics of their portfolio. And finally, give your shareholders a fairer deal with performance conditional tender offers. Thank you very much, and I look forward to your questions.
Thank you, Simon. And finally, Ewan.
Brilliant. Thank you, Susan. I think Charlie will be sharing the slides for me. Where, yeah, I've gone with a couple of titles here. The opportunity for change, which I think is apparent, and is a wave of consolidation underway, which mirrors a note I published in mid-July on this subject. So really important. I think if we go to slide 2 from my pack, but a crisis and a catalyst for corporate action. And what this chart shows you here is the number of IPOs in each calendar year and the fate that's become of those. So at the top, you've got the light grey, which is funds launched in that period that have continued in their original form, whilst at the bottom, you've got the dark blue, which is, sorry, can you hear me? Hopefully you can hear me. I will look for confirmation of that from the chats. Excellent. The dark blue is funds that have wound up or open-ended. And if you look at that attrition rate from the pre-global financial crisis, if you look at 2000 to 2009, only 254 of the 326 funds survive in their original form. 254 no longer exist. So an attrition rate of 78%. And if you look at mergers and realization strategies, you only have 16% remaining in their existing form. And that really represented a phase of reassessing the relevance of investment strategies. You know, how many Bulgarian development property funds did you need? You know, do investors need Kazakh private equity funds? And you know, did fund of hedge funds live up to expectations? So what will we see with the decade we've just seen IPOs? And as you can note, there was a little less exuberance. We haven't got the same peak, so I think a lower level of attrition rate, but certainly there will be an assessment of the relevance of strategies. There has been a bit more discipline in terms of structuring, and you know, that alternative income mandate will continue to strike true with many investors. But I certainly think you'll see a reassessing of some mandates, perhaps, you know, a new environment for the likes of aircraft leasing, and people looking with fresh eyes on the quality of assets and management, perhaps in some areas of specialist credit. And if we can move to the next slide, just there you've looked at the relevance of the mandate, but also the relevance of the vehicle, and Piers touched on that consolidation of the investment, the wealth manager community. I think that's really key, that the size and scale of a trust is becoming increasingly important. And here you can see in the light blue, around 50% of the universe, around 180 trusts, are sub 200 million. And what is small, and you know, historically it may have been 100 million was considered small, but I now think with that wealth management consolidation, trusts of 2, 3, 4, even 500 million need to look and assess whether they are appropriate size and liquidity for the investors. The institutional side of the investor base that Piers also touched on, you've seen a much greater focus on liquidity in that area post the Woodford scandal, and we've certainly seen selling of investment trusts due to that. And the right-hand side there, you see the investment trust discount by size bracket of fund, and showing that the smaller the fund, the wider the discount. I'll perfectly put my hands up and say that hasn't always been the case when I've looked at that data, but I think it's quite interesting that that's been that's the case at the moment with this focus on liquidity. And so really, as well as the smaller end of the spectrum, I think it's that middle ground, the 200-300 million plus, that do need to look and see, are you in the right position to attract demand, and is consolidation of some form the right answer? So we move on to the next slide. You might look at consolidation, its sort of purest form being mergers and acquisitions. And historically, directors and management groups and brokers probably seen as sometimes an obstacle to that consolidation. And I do see partly the issue there that some of the benefits are probably potential, and you're not quite sure whether they're going to happen, or some of the obstacles in terms of costs, the risk of managers losing assets, directors, brokers losing fees appear very real. But I think it's very easy to say, the cost benefits, both in terms of ongoing charges and potentially trading costs. But also there's some data here that I dug into, and the improvement in trading liquidity I think is quite interesting. So primary health properties and insurer, a recent merger in the sector, property focused funds, but there you've seen 100% increase in the liquidity compared to the combined liquidity of the two vehicles previously. For Standard Life Smallers, Dunedin, smaller companies, around 50% increase in liquidity. So it is substantial. And also, as a board, you do have many options in your hand. So the sort of claim that mergers never happen, I think, is a little bit unfair, because rollovers are often, essentially a merger in all but name, and there certainly has been plenty of those. But I think we like to see going forward more of those on the front foot as a way of potentially stimulating demand rather than a last resort. To try and save some assets that are otherwise leaving the sector. And certainly manager and mandate changes are sensible options, but you do need to look whether that solves all of the underlying issues facing a company. And sometimes putting the hands up and winding up can be the best option. But the next slide, is a wave of consolidation underway. It was a fairly timely note in mid-July, because it seems like it's happened since. Perpetual income growth, two companies that could very easily say we can stand on our own 2 feet, but creating £1 billion asset company, I think, is a big step forward and very positive. The likes of a bid coming in for Hadrian's Wall, the realisation vehicle, at a 90% premium to the trading price, showing that often we get a bit of mispricing in the listed sector, and a number of other live situations have come to part, a couple of which I'm not personally allowed to speak to due to restrictions. But there's more on the horizon. Temple Bar, a manager review ongoing, and really interesting to see a number of boards recommending voting against continuation, which we probably haven't really seen in the past. But we've got a couple of those coming up. And a couple of those have already come, the likes of Goodbelly Value Plus, which I think, if you move on to the next slide, was a very interesting case of who drives this change going forward. And, the blame can sometimes be levelled at boards, but I think, particularly having an engaged shareholder register and Investec Wealth, when public in their quizzing of Goodbelly Value Plus, and I think that was quite a game changer, that one of the biggest owners of investment trusts comes out and be somewhat aggressive looking towards requisitions. That is a change, and I think the conversations I've been having over the last month or so, investors really are looking to get more engaged, and you've seen Investec publish their views on governance and structure. Aberdeen's multi-asset team have done similar things, and real feeling of being fed up. A proactive board, I think it definitely is the case to look forward to the long-term options for the company, not defending it from its shareholders. Turkey's voting for Christmas. I didn't get the warning about being polite, so sorry, I'll put that forward. But I think the situation is very different, actually, because unlike Turkey's, we can invite you back for next Christmas. People keep their naughty and their nice lists, and so your options are, for winding up a company or acting in the best interest of shareholders will be noted, and you do have the potential to come back. Honest feedback from brokers certainly needed at times, and we do try to give it. And management groups that are looking to position for growth rather than defending their current position, particularly say proposing mergers within a management group when they might feel the board could take one or either of their mandates around. I know certain management groups are afraid of that. So just to wrap up before Susan wraps my fingers, a sum up really. The things you need to be considering, is the mandate relevant? Is it differentiated? Is it using the structure? Does it appeal to a wide range of shareholders? That's looking at size, it's looking at cost. What's in the best interest for the long term? So understanding those shareholder views, engaging with those shareholders, getting your feedback through your brokers, and do you need to challenge the status quo to attract that long-term demand from areas such as retail investors? And in summary, I do think investment companies as a sector and individually can use the COVID-19 crisis to assess their options and come out as stronger and more relevant to investors. Thank you.
Thank you, Ewan. That's great. Okay, well, without further ado, let's get into some of the questions. So let's start off with one for each of you. So if we go with Piers, first of all, a question had come through from Sarah Godfrey. Piers, you say D2C platform buying is mostly driven by Mr. and Mrs. Miggins coming to their own conclusions, but given the influence of, for example, Hargreaves Lansdown's recommended lists for open-ended, could the platforms do more to sell investment trusts? Piers, you might want to unmute.
My apologies. Sometimes you want me quiet. Yes, they can. And a lot of approaches are made all of the time to Hargreaves and Interactive. Actually, Interactive has a Super 60 list, which I think involves investment trusts, but everyone does a lot of work trying to encourage Hargreaves to try to take investment trusts more into the life set. I think the difficulty there, they both come from slightly different histories. You've got execution-only brokers, which in many ways have more of an affinity with investment trusts. Hargreaves and Mark Dampier in particular still looks at the product profitability in a slightly pre-RDR way. And although investment trusts exist in their world, and the Vantage investors massively use Hargreaves but they're not influenced so much by Hargreaves as a decision-making for their investments. So actually, the transaction platforms are often just that. What matters to get D2C is to actually influence, if possible, or do the visibility and media advertising using CityWire and all the other research outlets that people are using before they get to the point of transaction. So the transaction center and the influence center are not always one and the same. So my answer is more could be done, but an awful lot is already done through where people go, whether they go on TrustNet or Morningstar or the other panoply of tools that are out there. And I think it would be lovely if there was an epiphany at Vantage in particular to encourage more, but we're working around this issue as best we can with the platforms themselves and their other media.
Thank you, Piers. That's great. Can we perhaps give Simon a question now? Here's one from Jeremy Richardson. So, Simon, given your strong views on the full independence of boards, what's your view about board members having shareholdings in trusts?
We like directors to have skin in the game, and strongly dislike directors, particularly those who've been on boards for a long time, who don't have any shares at all. I don't think a shareholding compromises a director's independence. On the contrary, it aligns the director's interests with those of the shareholders.
Okay, great, thank you. And to round things up, let's have one for Ewan just now before we perhaps have everyone contributing to some of the broader questions. So, Ewan, can boards be too proactive in addressing perceived issues, for example, British Assets Trust?
Yeah, that's sort of tackling that very difficult issue of when to make a change. And I'll put my hands up and say that there's never a exact correct answer to when you should change your management group, when you should change your mandate. But I think generally we've probably seen a bit of lack of proactivity, which I think it is positive to see it when it comes. And I think it is that understanding what your shareholders really want and their views on things. Again, difficult because you never have a consensus of views, but really, engaging and finding out what people want. It's hard to be too proactive. I think there's been few examples of that in the sector, probably.
Okay, thank you. There was a question asked right at the very beginning by Hugh Aldous. I think Piers has sort of addressed it to some degree, but I just wondered if others had views on it too. How can we penetrate the nominee barrier that makes it very difficult to identify shareholders who trade through platforms? I think this is a sort of old chestnut in many ways, but it'll be interesting to get views. Simon, do you want to go with that one?
I think it's an excellent question. I've no idea how you penetrate the barrier, and I think we all need to be doing more to put pressure on people like Hargreaves Lansdown to make it easier for their for their clients to vote. It's not something that they proactively promote to their clients. It's a service that can very easily be provided, and I think in the interests of good governance, all platforms should be doing more in this respect.
Okay, thank you. Ewan, anything to add to that one?
Yeah, it is very, very difficult, and I would say, yeah, as our job as a broker, trying to look through and find the underlying holders when often you don't have the information is difficult, but sometimes part of the job, and that's where you probably see a few more sort of advisor figures than maybe sort of meets the eye. If you look through some of that platform advisor platform figures, they're often held through some of these platforms rather than directly. So it's a difficult task, and yeah, more clarity would make life a lot easier, but it's the job to try and sort of find those underlying buyers. Absolutely.
And Piers, did you want to add anything to that one?
Yeah, well, I've got the magic wand for you all. And the problem with share register analysis for boards, it's very old-fashioned. It never gets granular at all. What you need actually is a Section 793 database. And this can be orchestrated for you either in-house with your own people, or you get Richard Davis to do it. And they basically obliges the platform owners to reveal their underlying holders and run a database of it. And it's not difficult to organize. It's just something that just needs to be set up away. They are often, if you look at individuals, and there are not that many left on share registers as well, they're the least communicated to group in the planet. They may get an annual report if they're lucky. You have to run a database, and that's what the manager can do. They can actually then instruct the thousands of names that are coming through that are held by whatever it was, and that's part of the working parcel of day-to-day promotion. Just talk to them and get a database. 793. It's a boring name, but it's a legal obligation for them to give us the information.
Thank you, Piers. Now let's take one on discounts from John Boothman. Perhaps everyone, all the three speakers giving their view on this one too. On discounts, how do we get around the problem that investment companies value investors a bit like house buyers, all in favour of bargains on the way in, but not so happy with lagging share prices once they're invested? Ewan, do you want to take that one first of all?
Yeah, sure. It is tricky, and I suppose what we've seen, if you look at, say, the equity universe, the discount is now trading around 5% for investment companies, which is relatively narrow by historic terms, and alternative trading around parity. So you do have quite a large chunk of the sector that are trading around NAV, and I think that's reflected of a shift of the shareholder register, and really controlling the shareholder register and consistent demand from a diversified shareholder register is the way that you need to take care of that shareholder base, so that you don't get widening discounts of funds that are already investing. You're always going to have people who play in the discounts, but giving confidence that a fund can continue to trade around NAV through discount controls and through a shareholder register can give people to continue confidence, continue to invest when the discount is narrow.
Simon, Piers, anything to add to that one?
Any counterbalance to discount controls, and as much as we hear about buybacks and tender offers and whatever, eventually it becomes like eating your own arm, we always say. You know, you can eat your own arm, it's very nutritious, but then you run out of arms and you run out of limbs. The key thing is to try to find sustainable demand. And the only way to do that, if you're trying to actually get who is an appetite to buy the shares rather than always this corporate surgery, which is hovering in the background. And the only way I can say that is if you have an authentic purpose for being as a trust, can you actually find your target audience that actually wants to buy it? And then at that point, these more radical steps, where sort of radical surgery doesn't always have to leap in. And so therefore, an even program of just doing ongoing promotion and reach is the counterbalance, demand-based, rather than just always having to do magic surgery as a grand finale.
Thanks, Piers. I'm just very conscious that time is rushing on. I'd quite like to fit in one more question, which seems quite topical actually, from Pete Han. In the context of COVID, our thoughts on investors seeking different products perhaps? More conservative, ex-UK, yield, dividend? What's topical? Simon?
COVID hasn't affected our investment strategy in that sense at all.
Okay, nice and short. Ewan, a view on that one?
Yes, I think it's quite an interesting one. You know, getting new product, new IPOs is going to be tricky in the current environment, but we are starting to see new opportunities come. I think a focus on income is quite likely, but what's the level of income that people are now looking at? Has that rebased? I think is going to be a very interesting question. But there still will be new opportunities, but it's that the quality bar has to be exceptionally high at the moment, because most investors are focused on looking at their current investment portfolios and what the risks are there.
Absolutely. Okay. Now, just before we sort of finish off, can I perhaps ask each of our three speakers to give us, I guess, their key message? So let's do it in order of the speakers. So Piers, would you like to go first?
I've had a very good morning to hear so much on different views. I think the key thing is the governance weeds. It takes a lot of board time. And I think now with COVID-19, there's a lot of leadership and strategy, business strategy. My final message is to get business strategy right means you've got to worry about who your buyers are going to be and how do we get to them effectively.
Thank you. And Simon?
I just want to repeat the 3 points that I concluded with, which is set your sights on an institutional management fee, give us more ESG transparency, and give your long-term shareholders a fairer deal with performance conditional tender offers. Thanks,
Simon. And Ewan?
Yeah, I'd like to say I think a wave of consolidation and corporate action is underway at the moment, and key to that and getting it right for directors is engaging with those shareholders, current and potential. And I think, you know, there is a case that the investment company sector can emerge from this on a firm footing and stronger as a result.
Thank you, Ewan. Well, thank you to all three of our speakers for most interesting and informative sessions. Really appreciate the time you put into prepping up for this. And thank you also to our audience for attending. We hope you found it useful. We look forward to welcome you to the next one. We are, of course, very keen to hear your feedback, so please do let us know if there are any topics that you'd be interested in hearing more about, and we'd be very interested to get your feedback on that. So thank you once again, and enjoy the rest of your day. Thank you. Bye-bye.